Is Palantir a buy or a sell? Let's get started with the model. This is a large cap company, 127 billion market cap. They're trading at $56 a share, and they have 2.3 billion shares outstanding. Palantir builds and deploys software platforms for the intelligence community. One of the things they do is assist with counterterrorism investigations. They have Palantir Gotham. That's a software used to identify patterns hidden deep within datasets. Like many companies, they jumped on the AI bandwagon. They now offer an artificial intelligence platform. The company was founded in 2003, headquartered in Denver, Colorado. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow went down from 2021 to 2022. It was 184 million. Then it went up nearly 300% to 700 million in 2023, almost 1 billion in the trailing 12 months, so really nice growth. Look at these margins, 37%. That means they convert 37% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2021 and 2022. They had their breakthrough year in 2023, positive 200 million. Nearly $500 million in the trailing 12 months. So numbers look really good. Nice growth. They have pretty good net profit margins, 18%. So they convert 18% of their revenue into net profit. Revenue is a sales for the company, and that's gone up from 1.5 billion to 2.6 billion. A modest growth. Nothing crazy, but a respectable growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 93 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $78 billion. We divide that by 2.3 billion shares. And we get a calculated stock price of $34. They're trading at $56, so they're trading at a 64% premium. It's a sell according to the model. What do you think? Do you think it's a buy or sell? Let me know in the comments. There are 97 companies in the same industry as Palantir, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend very little on CapEx. Software companies don't need to spend much in CapEx. You can see these numbers are pretty small. Microsoft is not just a software company. They also make computers and other hardware, so they have CapEx spend, a pretty big number at 50 billion. Palantir is debt-free, so if you like debt-free companies, this is a great candidate. They generate 1 billion of free cash flow, a lot lower than the companies surrounding it. CrowdStrike is pretty close to it at 1.1 billion. They rank 4th in market cap. They've come a long way. I did own the stock at one point and I sold it. I could have made a really nice return. We all make mistakes, right? If you're a big fan of price multiples, the PE, price to free cash flow, the stock is really overvalued. They're trading at 28 times book value, 267 times earnings, 130 times free cash flow, and 48 times revenue. When you see price multiples this high, that means the market is expecting really significant growth. They're expecting big numbers in the future. Let's see if Palantir fulfills that expectation. They're not generating much revenue, 2.6 billion, not a lot relative to the companies around it. CrowdStrike is kind of close at 3.5 billion, but CrowdStrike is growing a lot. Their 5-year annual revenue growth rate is 59%. This company is probably close to like 7 or 8%. We saw their revenue earlier. It wasn't growing that much. If you put $10,000 into this company when they started trading, you'd be a happy camper at $59,000 today. That's a 54% annual return. I can't remember how much money I put into this company, but it was at least 10,000, maybe 20,000, and it was probably around this point. I ended up selling at a loss of like 10 or 20%. I'm such an idiot. But I put most of that money into Meta, and Meta's up like 400 or 500% since their low point. So to summarize, I have them trading at a 64% premium. The only reason the ranking is so low, 3 out of 10, because it seems really overvalued. If you think they're gonna grow a lot, then it could be a good value, but I would probably wait for it to come down a little bit more. But I said that about Nvidia, and I sure have egg on my face about that. Would I buy a 5 out of 10? I think I would buy it, but I'm not itching to buy it. Like I said, I think if it comes down another 20-30%, it's a much better value. Ratios are terrible, 1 out of 10. Really high price multiples. Financials look solid, 8 out of 10. Free cash flow is up 200% since 2021. Revenue up 72% since 2021. They just released their third quarter earnings this week. Let's go through their presentation slides. Revenue up 44% year over year. It's $500 million for the quarter, and it's up quarter over quarter, 14%. Quarter over quarter means it's comparing second quarter of 24 to third quarter of 24. Year over year is comparing third quarter of 2023 to third quarter of 2024. Everything is up. U.S. commercial revenue, 54%. This is when they sell to companies like Ford. U.S. government revenue, that's their big revenue. They sell a lot to the U.S. government, up 40%. That's $320 million for the quarter. In the quarter, they closed 104 deals, all worth over $1 million. So they have big contracts. Operating income, $276 million, 38% margin. That means they convert 38% of their revenue into operating income. Net income, $144 million, 20% margin. That's kind of like the sweet spot, 20%. If you could get to 20%, you have healthy margins. Of course, above 20%, like NVIDIA's like 40%, is amazing. Their Rule of 40 score is 68%. The Rule of 40 is used for software companies. It's when you take your revenue growth rate and profit margin, the sum of those two numbers. If it exceeds 40%, then you beat the 40 rule. So SaaS companies above 40% are generating significant profits. Companies below 40% may run into cash problems. Here's the Rule of 40 by quarter. It was as low as 38% in the second quarter of 2023. Now it's at 68%, their highest ever. It's kind of arbitrary how companies calculate the 40%. Some companies use GAAP, some use non-GAAP. Some companies use net margin, others use operating margin. So I think the 68% is a 30% revenue growth year over year and the 38% margin from adjusted operating income. A lot of companies use adjusted because it pumps up their numbers. Adjusted is when a company strips out things like stock-based compensation and other non-cash expenses. Here are some U.S. commercial projects they're working on. The bottled water manufacturer. It took them 50 days to get to a 7-figure ACV deal. ACV is the annual contract value. 7 figures means it's $1 million deal. So it took them 50 days to get $1 million deal for this project. It might have been more than $1 million. It could be $5 million. Of course, $1 million is 7 figures and $9 million is 7 figures. They had a healthcare project. It took them 3 months to get $1 million deal. And they provided software to an agriculture company under 2 months to get to a 7-figure deal. As you probably know, they're part of the S&P 500. Not many companies make the S&P 500, but they did. There are actually 503 stocks in the S&P 500 because there are 3 companies that have more than one stock. Google has 2 stocks, GOOG and GOGL. They don't just work with US governments, they work with foreign governments. The Ukrainian government is working with this company's AI product in their demining operations. They're looking for mines. So instead of stepping on the mine and killing people, they're trying to identify the mines and then blow them up so nobody accidentally walks on it. AI is transitioning the battlefield. Their AI software is being used by the US government and other governmental agencies. In the third quarter, they signed a 5-year, $100 million contract with the US military. That contract is to expand the Maven Smart System. The Maven Smart System is an AI-enabled platform for geospatial visualization. The main purpose is to aid in relief efforts, so to aid other countries. You know, the US, we're always trying to help other countries. Sometimes our citizens take a back seat to other countries. They have autonomous drones, and those are used in GPS-compromised areas, so areas that don't have good reception. It could be really helpful because it provides accurate navigation. Because you know when you lose reception in a car, it can get really stressful, a lot of anxiety, especially if you don't know where you are. Could you imagine if you're way up in the air, so many thousands of feet, and you don't know where you are? Here's some high-level financial information. U.S. commercial revenue up 54% year over year. Their customer count is up 77%. They closed 130 deals in the quarter, and the total contract revenue is almost $300 million. Palantir works with a lot of big U.S. companies like AT&T and Merck. Here's their GAAP earnings the last 5 quarters. It doubled since Q3 23, $72 million to $144 million, almost exactly doubled. Net income is revenue minus expenses. GAAP net income is according to GAAP, according to the U.S. accounting rules. Operating income is also up quite a bit, $40 million to $113 million. Their revenue a year ago was $345 million, up 44% to $500 million. That's just U.S. revenue. And they break down their U.S. revenue between commercial and government. So commercial is 179 million, government 320 million. Both up quite a bit from last year. So their total commercial revenue, 317 million. That's U.S. and non-U.S. Total government revenue, 408 million. So total revenue for the quarter, 408 plus 317, 725, which is right here. Total revenue, 726. So it's a rounding thing. Up 30% from last year. Margins are getting better. 29% last year, 38% this year. So that means they convert 9% more revenue into operating income. So not only is their revenue going up, but their expenses are going up at a slower pace, which is how you get higher margins. Here's their number of U.S. commercial customers, 181 up to 321, a 77% growth. It's not like they have a business like Starbucks where each customer spends 20 or 30 bucks. Their customers spend millions, sometimes tens of millions. Their total customer count is 629, up 39% from last year. And their total commercial customer count, this includes international, is almost 500, up 51%. So in the third quarter, they closed 104 deals valued at over $1 million. 36 of those deals had a value of $5 million, and 16 over $10 million. So one or two real big customers can really move the needle for this company. Operating cash flow, $133 million last year, now it's $420 million. Operating cash flow margin, 58%. That means they convert 58% of their revenue into operating cash flow. Remember, operating cash flow is net income converted to cash. So you take your net income and then you add back the non-cash items like depreciation and stock-based compensation. Free cash flow grew from $140 million to $430 million, 60% margin. The forecast for the fourth quarter is revenue of $770 million and operating income of $300 million. For the full year of 2024, $2.8 billion of revenue. They completed the first 3 quarters, 1 more quarter to go. And they project U.S. commercial revenue almost $700 million, which would be a 50% growth if they hit that target. And they expect to break $1 billion of adjusted free cash flow for 2024. Their outstanding billings are $823 million. Those are the amounts that are remaining to be billed on their customers' contracts. You could think of this as their unearned revenue or deferred revenue. This is just their current customers. And if they get new customers, then that adds to their revenue as well. So that's a good thing to keep track of, deferred revenue, because this is revenue they will capture in the near future. Here's their revenue growth by quarter. 18% in Q4 2022. It did fall to 13% in Q2 2023. The stock probably dropped when it fell to that level, but as you can see, their revenue growth is going up. It's at 30% for the current quarter. So they're growing even more as a percent. And their rule of 40 is growing as well. It was 40%, now it's 68%. The goal is 40, they're easily over 40 now. Let's look at the stock on Simply Wall Street. Its last price, 56, 127 billion market cap, up 35% in the past week. When it's up that much, that means Wall Street was really happy with their earnings. Up 200%, the stock has tripled in the past year. They beat top and bottom line forecast in their third quarter earnings. The earnings they released this week. Top line is revenue, they beat by 3%. Bottom line is earnings, they beat by 10%. You could click this arrow and you can see the expectation for revenue was $704 million. They reported $726 million. And the EPS expectation was 9 cents. They reported 10 cents. So the market was happy they beat top and bottom line. Another thing that affects the stock price is the forecast for the future. Here's an article in Forbes. Despite the company proving they're one of the few software companies with real revenue growth, the valuation is even higher. Price momentum may soon be approaching a peak. So once it hits that peak, there's going to be a big sell-off. So you want to get out before the sell-off. They beat Q3 revenue by more than 21 million, and they boosted guidance from 2.75 billion to 2.8 billion. Those are the two things that really move the needle. Actual earnings results and guidance. So a company can crush earnings for the current quarter and the stock goes down dramatically if guidance is really poor. They started trading at the end of 2020 around $10 a share, and right away the stock jumped. After 3 months it was up to 36. So it was up like 300%. But then it fell real low. Its low point was $6.35. And that was in the beginning of 2023. An amazing time to buy the stock. because ever since then, it's done really well, especially the past week. Look at this straight line up. On November 4th, it was 41, and now today it's 56. Simply Wall Street values them at $40. They say they're 39% overvalued. I honestly never look at the valuations before I do my video. This is the first time I'm seeing it. I'm at 34, a little lower than Simply Wall Street. It's very rare that Simply Wall Street has a stock that's overvalued. They usually use a really low WACC. Let's see what they used. 6.8%. I use 7%, and that's really low for me. I'm usually between 8 and 10%. 16 analysts priced this stock at 37, really close to me. This purple line on the bottom is the analyst forecast. This blue line is their actual stock price. So you see the analyst forecast was $14 last year, and as the stock price goes up, so do the forecasts. Here's their previous free cash flow and the forecast. So you can see the forecast is $1.5 billion by 2026. And I use that same exact number, $1.5 billion. But my growth was pretty aggressive. It was $4 billion in 2027. And the stock still seems overvalued. Simply Wall Street's $2 billion in 2027, but they go out 10 years. So they go out to 2034. So they grow it to $5.5 billion by then. And then they do their terminal value. I do my terminal value after 4 years. Their revenue growth is pretty impressive. In 2018, it was $600 million. So it took 3 years to double. By 2021, their trailing 12-month revenue was $1.2 billion. History is repeating itself. It took another 3 years to double from $1.2 billion to $2.5 billion. That was in June. So now their trailing 12-month revenue is $2.6 billion. Do you think it's going to double again? By 2027, will it be $5 billion? There's a decent chance. Software companies don't usually need that much CapEx. Manufacturing companies need a lot of CapEx. Software companies usually don't spend nearly as much. The way a lot of companies get money to spend on CapEx is through debt. They did have $400 million of debt in 2020. Since 2021, it's been zero. They've been debt free. And their equity is improving each year. Now it's at $4.5 billion. And all that equity is cash, which actually makes it less impressive. Some people think cash is so important, a company needs a ton of cash. I would actually prefer to see most of the equity value in retained earnings, not just cash. Because the way to grow a business is not to stockpile cash. It's to invest and get a good return on investment. The CEO's salary went from $900K to $1.1 million. Total compensation $3.5 million, tenure as CEO 22 years. Peter Thiel is the co-founder and chairman of the company. He was one of the early investors in Facebook. He started PayPal with Elon Musk. He actually fired Elon Musk so he could take over as CEO. No insider trading in the past year. Half the company is owned by the general public, 44% by institutions and 8% by insiders. Vanguard is the biggest shareholder at 11%. Peter Thiel owns 4.5%. The CEO owns 2.5%. Another prominent investor, Stephen Cohen, 0.6%. Kathy Wood's ARK, 0.5%. And their employee count looks pretty good. It went from 2,400 to 3,900, the highest point ever. It's nice to see a company that hasn't cut employees dramatically. Lots of companies have reduced employee count a lot. So this indicates they're growing at the right pace. Because when you lay off a lot of employees, that means you overspent in the past. It indicates you didn't need that many employees at one point. That's why you had to cut so many. And the ticker trades on the Wiener Börse, London Stock Exchange, New York Stock Exchange, Deutsche Börse, Zitra, Mexican Bolsa, Bulgaria, BATS Europe, Sao Paulo Bolsa, the Lima Bolsa, and Buenos Aires Stock Exchange. So if you want to become a guru on reading financial statements, click on the video in the top right corner. Thanks for watching.